Welcome to today's webinar, courtesy of the Kentucky Small Business Development Center in Louisville. Discover no-cost, valuable business services to help you thrive, whether starting your entrepreneurial journey or scaling your existing business. We have the resources and expertise to help you succeed. For more information, please visit our website or text 502-977-5800. Thank you for joining us today. Feel free to use the chat feature to ask questions or engage with our speaker. Let's get started.
Hey, welcome everybody. I'm
There
still
we
having
go.
trouble with my video again. I can't believe it. So, hey everybody. There I am. Nope, there I'm not. Maybe. Oh, come on. There
You
I
go.
am. Oh man. Happens every time. So,
Something in the
yeah.
ghost in the machine.
So, welcome everyone. Welcome friends. Thanks for joining us today for another Toolkit Tuesday. I'm Dave Etkin, the director of the Louisville Small Business Development Center. I'm joined as always with my good friend and co-worker, Janet Flaw. Hey, Janet.
Hi, good afternoon, everyone. Welcome.
Yeah. So, just because we seem to be technologically challenged, if you wouldn't mind just making sure that you can see and hear us. If you look at the bottom of your screen, you should see a toolbar. If you don't, just take your cursor and hover around down there. It should pop up. There you'll see the little chat feature. If you wouldn't mind just typing in your name and saying hello and tell us where you're joining from. That way I know that you're out there. I can see some people popping in. But that doesn't mean anything. You could be just looking at a blank screen. So if you wouldn't mind saying hello and put this in there. There's Dave Sauerbach from the Sauerbach Family Drive-In in LaGrange, Kentucky. How are you, Dave? We'll be coming out to see you here this weekend. So keep the popcorn hot for us. Makisha in Louisville, how are you? Good to see you. Hi, Jamie. Jamie from Elhome, one of my good friends. Hey, Fausto. We need to catch up. Good to see you. Hi, Katie. How are you? Katie's also with the Small Business Development Center in Berea, just like Fausto is in Lexington. So, hey, Matt. How are you? Yeah, got got a lot to go over today. I really appreciate you guys joining, taking some time out of your day. Financials are not that exciting subject to talk about, but they are so important. So I will do my very best to get everybody as excited about financials as I am, because I do enjoy a good financial analysis. I hope you do too. So I'm going to share my screen here, and we're just going to jump on. So if you, how are we doing, Janet?
Doing good. Just go to slideshow.
Okay, good. All right, working. Come on now. Come on. There we go. Finally.
There you go.
All right. So, yeah, the financials are really what makes a successful business. Over my career and all the people we work with, the thousands of people we talk to, there's just generally a trend that if you get financials and you understand them and use them, your business will be successful. It's just a given almost. So today I'm going to show you some things that I've learned over the years, some of the tools that show you what your gut can't, because we run into a ton of people that are just kind of managing by the gut or the seat of their pants, which isn't probably a great way to do it. But what are we going to do today? We're going to do basically two things. We're going to look at the four main ways to analyze your financials. And then secondly, and if we have some time, we'll look at using what we've just learned to create a budget for your business. Now, as we go through things, if you put your questions or comments in the chat. I'll try to keep an eye on that, and then we can just have a little chit chat, if you will, and see if we can't get your questions answered. If you have any comments, whatever, it doesn't really matter. We'll just have an open dialogue today. So the top 4 analysis tools. Let's jump. I'm Dave Etkin, the director of the Small Business Development Center in Louisville. Please reach out to us. You can check us out at KentuckySBDC.com. We are, like the video said, we are a state and national program, so there's always an SBDC near you. Please take advantage of the free service. I got my start a while back, a long time ago. My first business that I bought and started running and screwed up and had the SBDC come out and see me, and they really helped me out way back in the day. So I've always found great value in the SBDC, and I think you will too if you haven't already. So reasons to review your financial and set business goals. So reviewing your financials tracks progress to your goals, and basically tracking progress is probably the most important thing you can do. If they say, studies have shown, if you want to lose weight, the number one thing you can do is weigh yourself every day. And this is more or less what your financials are doing, if you let it. Business goals help you avoid distraction and keep you focused. As entrepreneurs, and if you're an entrepreneur, you automatically have ADHD. You see all kinds of opportunities. All day long, you're coming up with ideas that you want to implement. It's just constant. Let's do this, let's do that. But it's really important to keep focused, and your financials will tell you whether it's a distraction or not, or whether you should keep focused on what you got there. The more you understand your financials, the more you can grow. You can understand if you can put these financials together, you can do analysis and an opportunity to see if it's actually accretive to your business. It actually adds to your business going forward. And so you can choose your destination. When we get down to the budget portion, we'll dive deep into this, how you choose your future and work towards that. And once you choose your destination, you gain control of the trajectory of your business. You are not at the mercy of anything else. So the number one main tool is financial statement analysis is called horizontal analysis. So if I was to put this up there, and I hope you can see it. This is just a simple P&L, just shows our sales at the top, our gross profit after cost of goods sold, all our expenses, and then our net profit at the bottom. And this shows us the activity for this particular year. And so there's nothing wrong with this. But the issue is that we have with this is that it is just showing you quantities. And quantities are fine, but there's no way to make decisions or understand the backstory of just a quantity. We need to understand the quality of these numbers. And the one way to do that is to look across horizontally. We have to add data. We have to compare. And anybody can compare. I had a cat, Henry, who could compare what he was eating because he didn't like certain things. So if we look at the last 3 years, we can look and see there are certain trends if we just go definitely across. Our sales are increasing. They're doing great. Our gross profit has increased a little bit. Our expenses, is as they are. So this is a great way to just look across and see how things are going. Now we can add more to this, which really increases the quality of it, is what we call common sense state analysis. And that's just a fancy word for adding just another piece of information to what we just looked at. And if you're using QuickBooks, and almost everybody does, you can set this up with just a checkbox. And you take your financial statements, your P&Ls, and then you add another column in where it shows you a percentage of sales. So at the top, next to our sales would be 100%. Then everything else is a percentage of that. So that adds another flavor of quality that we can look at. Because sometimes the numbers, even though we're looking at them side by side, the percentage tells us a relationship, which is more important. So the way I like to think about this is that our total sales is 100%. I can just say that's $1. And if I look at my top three lines, my sales, my cost of goods sold, and my gross profit, the story there, if I'm using percentages, I can say for every dollar I sell, it costs me 50 cents. I get to keep 50 cents in 2022. That's the story. And so that's, for each, I can use each line item to make that case as I look at things. So what's interesting here is, again, our total sales are 100%. Our gross profit as a percentage, you can see how the trend is kind of fluctuating a little bit. The gross profit is important because, sales are kind of a, I don't know, vanity number. They don't really mean that you're actually making money. What really means, the most important thing is that your gross profit percentage is something that will support everything else. The other thing that's important here to look at is the owner's compensation. While it's pretty low, you can see that it's been decreasing. But as a percentage of sales, it is really drastically kind of dropping down 2%, which is fairly low. So this is important to know later on as we do some other analysis. So our total payroll is increasing a little bit. Here's another story that we look at. In 2020, our rent was low, but then it popped up. So that's a story that we would need to ask questions if we were looking at this, but we would know that if that was our business. And so our total operating expense as a percentage of sales has increased 2% to 40%. So these are all things that help us identify where things are that, we're as busy business owners, as entrepreneurs, we don't have time to dig into everything else, but it's important to do that if you can. But this gives us targets because there's anomalies here that we would want to look at. Another good thing to do here, I'm not going to show you this, but I'm just going to tell you, is as you go through each line and as you go across horizontally, and you notice a change that's fairly drastic, I like to make a note out to the right. Why did this go up, or was there a special expense here, or did we get a big contract, or whatever? So that way you can ask others in your business, your bookkeeper, or go back through your records so you understand what these things are, and make sure that at first there's not a mistake that somebody classified something wrong if you're using a bookkeeper. Or if there was a one-time expense that needs to be dealt with. So these are all things that you would want to be aware of. And then you can see our profit has kind of dropped significantly over the years. Okay. Now next, we can take the numbers out and just leave our percentages there. This is the actual common size statement. And this is important because this gives you your basic business model from a financial standpoint. When we get into benchmarking, this is important because you can use this model setup to compare yourself to other businesses that may be bigger than you, so the dollars don't make sense, but the relationship of the dollars do make sense. That's why we do it this way. So you can see that, again, our operating expenses increased quite a bit, and our income has been fairly steady. And our net profit has dropped a bit. But this is, with QuickBooks, another click of a checkbox. You can put this statement out and put it together. Now, to understand whether you're doing well or not, we can compare another way, and this would be through benchmark analysis. If you were to get a library card and go to the Free Public Library's website, they have benchmarking studies that you can pull for different industries. So one is the Risk Management Association. I think they got a new name, but I think that's still RMA. But what these folks do is they aggregate financial statement data and tax returns from industries all over the United States. And so they sort them by industry. And what they'll do is they'll sort revenue size, like over 5 million, under 5 million, and then they'll turn into this common size statement analysis, what we just looked at. So that way you can compare your business to another business in your industry, which is sort of similar in size. And if you layer that in, then we can, put it side by side with our data, and we can understand where our opportunities are to compare ourselves to a well-run business. So number one is, as the owner here, I'm paying myself 2% of my sales, but the industry average is 7%. So that tells me that there's an opportunity for me to make some more money if I'm more mindful and do a little bit more analysis of where the opportunities are and understand what I'm doing a little bit wrong, or how I can improve things. Our total operating expense for our company is 40%. The industry average is 36%. So there's some sort of cost structure here that's somewhat out of whack that we would want to explore. And then our operating income is 10%, but the industry average is 18%. So somewhere in there, somewhere in the way we're doing business, we need to improve or look for those opportunities, because there's an opportunity for me as the owner to make some more money, and there's an opportunity for the business itself to be more profitable. We can also use that same data from the RMA. They have a whole ratio analysis based on the industry data. And so ratios are just a comparison between different financial statement numbers. And it's a way to, another way to analyze things. And it's a way to cross-reference between the different statements. Like what we've only been looking at is the income statement up until this point. But some ratios will compare numbers from your balance sheet, your cash flow, or your income statement to get information. So there's 4 main ones, but you can make up your own ratio. I mean, if you're in the food business, I used to make them up all the time, and each industry, has their own industry-specific ratio. So using the restaurant industry as an example, because everybody kind of understands restaurants. The one that I used a lot was check average, which would be total sales for the number divided by the number of people that came in through the door that day. And that just tells me on average, anybody that walks through the door is going to spend X number of dollars for the day. And I can use that to make decisions and things. So from an accounting standpoint, a liquidity ratio just measures the ability to pay short-term expenses. Our activity ratios, they measures the way a company uses its assets to generate revenue and profit. And leverage ratios measures the ability for the company to pay long-term debt. And then profitability just tells us, are we able to earn a good profit and get a return on investment for the owner? So this is and going forward, we're going to look at a couple spreadsheets and things that I use. And when we will send the recording and stuff out to you, and I'll send these out to you as well, so maybe you can find them helpful as I do. But again, you can make up your own here. I'll make up my own stuff, but these are the standard ones. So in this sheet, there's the formula is there. And I'm assuming that everybody has decent financial statements, all 3 of them. If you're using a bookkeeper or QuickBooks, you should be able to get this information. Working capital is just let's talk a little bit about these sort of things. Working capital is just your current assets divided by or subtracted from your current assets, and that just says if you paid all your short-term liabilities with your short-term assets, you'll have X number of dollars left over, and it's sometimes businesses have a negative number, and that's not comfortable to be in. Your current ratio is where you divide your current assets by your current liabilities. And to translate ratio speak here in 22, we had, was that 1.9? That just means for every dollar of debt I have there, that means I have $1.90 to pay those short-term debts. But again, the most important thing here is not to get the number, but to look at the trend and see where the trend's going, whether it's positive or negative. We can also use the benchmark data from the RMA report, I've layered this other line in there, to see how we stand up against our industry peers. And so that kind of gives us some indication of where there's some opportunities for improvement. So now we've gone through and looked at our financial statements, and we can use all that now to kind of build a budget for your business. So it's June, we're halfway through the year. Most companies will build a budget for the year in November and December and try to work through that going forward for the rest of the year. There is nothing wrong with starting where you are. I mean, maybe it's August and you don't have a budget. Well, you can still create a budget for the next 3 months. It doesn't really matter. But mid-year reset is a great way, a great practice to look and see where you've been for the first year, and then maybe do some resets for the second part of the year. So there's a whole process to create a business budget that I use, and it's a little bit different than I think you would think, but let's just get into it and we'll see how it goes. But a lot of people don't even use a budget because, I've had these arguments with myself before, like it takes some time and I'm just predicting the future and who knows what the future will hold. So why waste my time doing it? But putting together a budget to predict the future, which is what you're doing, is just like putting goals, you're having your personal goals. There's a ton of studies that show that you are 60% more likely to achieve your personal goals if you write them down as opposed to just thinking about them. So the mere act of writing them down, I don't know what what it does, but it puts the word out to the universe or whatever, and you're more likely to achieve those goals. And it's no different when you put together a personal or a business budget, is having that budget written down. It's really crazy how this kind of works, but it's also hard to create a budget if you don't have good financial information. So step number one is like, get your house in order. If you haven't done that already, I mean, mid-year, now's the good time, just bite the bullet and do it, Also, we are busy. We are busy as business owners, and we've got stuff coming at us all day long. And now this is one more thing I've got to deal with. So, no different from starting, with a bunch of New Year's Eve goals. The New Year's Eve goals tend to last for 3 weeks and then they go away. A lot of times when people start a budget in the first of the year, same thing, kind of falls apart. So, yeah, you have to be disciplined by this. And the thing that is the worst is if you ask your bookkeeper, somebody else to prepare the budget, and you don't really bother to look at it. That is a total waste of time. So you as the owner, you as the leader, you as a decision maker, you have to do this because that's the only way that it's going to trickle down and work. So number one, make sure your data is correct. Get your house in order, get on your software, make sure everything's in good, set up correctly, is your chart of accounts right? If you have outstanding transactions that you haven't entered, if you have invoices that you haven't put in yet, whatever. But, this is your business and the buck stops with you. So you really need to put this all together and make it real, make it work. So print out all the reports, the profits and loss balance sheet, and then do what I said earlier. Just look at every line item, understand, what that number is, what it's telling you, how it got there, ask questions. If your bookkeeper set this up, most likely your profit and loss statement is set up and all your financial statements are set up from a tax perspective. Now, we're not doing taxes here today. We're doing a budget. We're managing in a business. So there's no reason that you can't have different layouts of your profit and loss statements based on what works for you to make decisions, not for taxes. So yeah, you'll have those. Your bookkeeper will keep that. That's fine. So once the data is in there, you can have saved reports that will come out with different formats that you can use, and your bookkeeper will get ready for the CPA and do their thing. But we need information that makes sense to us. So we'll talk a little bit more about that in just a second. So like I said, we have multiple views of the data. And what we're trying to get to is a couple things. Is we understand the true cost of goods sold and services sold. So again, we're not doing taxes here. We're trying to get information so we can categorize our expenses into different formats that make different sense for us. True story. I was working with this company and they were showing massive losses. And when I was digging into it, I was thinking, how come they're not in bankruptcy now? What's going on here? And the owner was really kind of flipping out about no matter what he did, he couldn't get into a positive profit sense. But they had cash and they seemed to be doing great from a cash standpoint. And what had happened was they had kind of a contract. And again, I'm not a tax professional, but they had a contract that they owed they owed someone some money, but it was set up as a contract, not as some sort of debt. And so that contract showed as an unpaid AP that was being drawn down, and it threw them into the negative almost every month. And once I told the owner about, we need to switch this over and have another report for you from a cash standpoint as opposed to an accounting/tax standpoint, then he could see, well, yeah, we're actually doing pretty well. And he was able to make good decisions that way, and he could sleep at night a little bit. So you can categorize things any way you want. So I sometimes use what I call discretionary expenses, things that we're, spending money on, but I don't have to, and I lump those together so I can easily see where they are. Or, you can move items into non-operating expenses. Whatever makes sense to you, you can do that. So what we're trying to get to is the big picture. We want to get all the information so we can step back and understand our numbers and then make some big decisions. And when we start to analyze for a budget standpoint, what we want to do is start at the bottom. We want to flip our P&L upside down. We want to start with our net profit first, and then look at operating expenses, then cost of goods sold, and then finally the revenue target. And this is where we start the budgeting process. So net profit, we want to know how much profit should we make. Profit is basically what's left over after all the expenses, and your salary, and so when we were looking at the benchmark, our industry profit was 18%. So we could start with that. So I would flip that up. We would start with 18%. Our operating expenses, we need to look at in there. We would want to make sure that it's just normal costs. This is what's called normalizing the P&L. So if you had like a lawsuit judgment in the year and you had to pay out a sum of money, but that's the first time and hopefully the last time that ever happened. Well, you would want to take that out because that's not a budget item. You know, we want to get through all that. We want to review expenses line by line, include your salary. Now, we looked at our benchmarks and we knew our salary was 5% lower than what the industry average. Well, let's bake that into our budget. You know, let's boost that up a little bit. And look at these things. Are there any reductions in our expenses that we can do? You know, is there anything else that we can really push hard and make changes on, and add that in there? Typical expenses that we would want to look at is, you know, wages and salaries, owner salary, utility, whatever. You know what it's all about. Just bake those different things in. Next, we want to move up into the direct expenses. You know, these are the things that change as revenue changes. You know, so, you know, if I sell more, then those costs go up. So if I have a restaurant and we're really busy and we're really rocking and rolling, and so I have to order in a bunch of stuff, well, my cost of goods sold is going to go up, but everything else is not. You know, the rent will always be the rent. So, you know, these are direct expenses. These are variable expenses. You know, they vary, you know, with our sales. So, but you know, look at these things. Is there things that we can do to reduce those things? You know, there's other things that we can add into the cost of goods sold. Again, we're not doing taxes, that make sense for us. So like if this was a retail or a restaurant, you know, sometimes again, this is not accounting, but sometimes I like to add in credit card fees because they are a percentage of sales. In my mind, they're variable. Usually they're tucked down in the operating expenses, but in my mind, they're kind of a cost of goods sold. You know, so the more I sell, the more my sales tax is. Yeah, tax is not supposed to be cost of goods sold, but it makes sense to me, so I can set it up. You set it up any way you want, but that's the way I like to do it. So we're just setting things up to make sense and see if we can make any changes. Now we can change our cost of goods sold two ways. You know, we can maybe find a different supplier or change our things up. In case of a restaurant, like we can change the menu mix, or we can go to the top line and raise our prices somewhat. That changes the relation to our cost of goods sold as well. So now the big question is, we've set out our cost structure, and now we need to know how much revenue, what's our revenue target for the year, for the upcoming period, for the year. So what we sort of need to do is, you know, we put together our target profit. We've got our operating expenses. We need at our cost of goods sold, and that is our revenue target. So we made a decision on how much net profit do we wanted to make. You know, we estimated our expenses, we estimated our cost of goods sold, and then that gives us our revenue target. Sounds easy. What do you do? How do you do that? Well, I use this handy dandy spreadsheet here. It's basically a break-even spreadsheet with a different flavor to it. And again, I'll send this to you. This is something I use all the time. It's really great. So as we know, costs are in two flavors. You know, we have our variable costs, which are always a percentage because they're in relationship to the sales line, you know, 100% less our food cost or whatever it is. And then our monthly fixed costs, which is just, you know, the things that we have to pay month by month by month. They don't change. So if we were going to do this budget, you know, and I'm trying to get my number, I would work it out this way. So I plugged in some numbers here. So I have our food costs, you know, since we're fast, we have paper costs, our hourly labor budget, a little bit for advertising. I baked in my variable cost, my profit of 7%. I should have changed that to 18, but it's 7. My mistake there. And then that gives me our total variable cost of 66%. Then I just layer in all my monthly costs, you know, whatever they happen to be, rent, total debt service, you know, what's my loan payments for the month. And then a couple things that at the bottom here, I always like to bake in an emergency fund on my monthly fixed costs. And you ever listen to Dave Ramsey, but having an emergency fund for your personal finances is super important. Same thing for your business. So if you can only afford $10, start with $10, but always, always, always pull out 10, whatever that number is I like to do it on a weekly basis. I always do it on Wednesdays at noon, it's automatic withdrawal out of the operating account. I don't know. That's just what I do, but you do you. And then bake in your salary. So if you want to give yourself a raise, plug it in there right then and there. And so at the bottom here, we can see what our break-even sales are for this model. This is just our first pass. So you can see annually we need to hit $554,000 to break even. I like to break things down so I can understand it. So that means 46,000 for the month, 10,000 for the week, and 1,500 for the day. And I like the daily numbers because I know as long as I've sold $1,500 worth of stuff during the day, I'm doing okay. And since this is not really a break even, this is a business model because I've baked in my profit, I've baked in my emergency fund, I've baked into my salary, whatever it happens to be. As long as I hit 15,000, I'm a profitable business. I'm not breaking even, I'm a profitable business. So that's why this thing is so cool. So now we know that to do this, to make this work for us, we have to hit $554,000. Okay, cool. We need to figure out what our revenue gap is. And, our revenue target is 554. What's our last revenue? Our last year's revenue was 411 on the P&L. And so if we subtract those two out, it's kind of rounded up and down here. That means we need to somehow increase our sales $139,000 from where we were last year, this year, to get to that. And, we just need to figure out if, again, we go back through again and see, can we reduce expenses? Can we, change our cost of goods sold percentage, whatever it is, just gives you a sense to go back through there. What can we do to increase sales? What can we sell more of? Can I increase my prices? So these are all things to have. We might want to go back through the budget again and make another pass on this. But these are all things that give you some indication of strategies to use to go forward. So always review this with your staff. Tell them where we got to go this year. That's where we're heading. Can everybody come up with some different ways to put this together, so that hey, thanks for that, Jamie. Understand where the opportunities are and what we can do to achieve them. So you can use the budget function in your accounting software. It's in QuickBooks, they have a good budget stuff, and you can add once you have your budget, you can plug those numbers into your QuickBooks, and then it'll add another column where it compares your actual to budget. I know a lot of companies that do that. It's totally up to you how you work. I can't work that way. I have to have, it's called like a rolling 12. I have to look 12 months back to see the trends and stuff. I just can't go from a budget this month to last year's budget or whatever. So don't do this alone. This is the most important thing is, if you have people, with you, if you have employees and stuff, share with everybody so everybody understands, what the issues are and where we're going. Here's some cool tools, that you can use. A little shout out to SCORE. They've got a ton of nice little spreadsheets and tools that you can use. Vertex is a free site. We can download Excel spreadsheets. I live and breathe Excel. I know there's a bunch of Google Sheets people out there, but I'm not one of them. So that's where I download all kinds of stuff. So check some of those things out. And that's about it. Ooh, we start kind of ended a little bit early today, but I hope that was helpful. And I don't know if anybody's got any questions, and don't see any other questions. Yeah, we will send you guys these spreadsheets. I find them super helpful. Um, like the break even, I use that all the time. It's really good to make decisions and stuff. So, like the break even, once I kind of set it up, I just change numbers to make decisions. And if I want to make more money, I'll just plug in my dream salary and see how hard it would be to get there, or if my profit percentage, or if you want to budget so much in for advertising, or whatever it is. It's a great tool. So. Anybody have any questions or comments? There's a lot of crickets out there. I know you're there because I can see you breathing. Yeah. So, well, I guess everybody's so quiet today. Yeah. Well, I know financials are super exciting, and everybody feels like I do, but so. And if nobody has any questions or comments, I guess we'll just kind of wrap it up here.
We tell everyone about next week's Entrepreneur's Edge, what we're going to go over.
That's true. Yeah. So next week, every now and then, there's three of us here, coaches on the team, and um, we'll just share a little bit of information and then just open it up to questions from you guys. Next week, we're kind of diving into some SBA loan products, other loan opportunities. One of the hardest things to get for your business is financing, funding. And we're kind of lucky in that, we work with different banks and different organizations all the time. Actually, Jamie Keith is here on the call too. You can say hello to her in the chat, but she's with Elhome, one of our favorite financial institutions here in town, and they're very good folks, very good friends of ours. So if you have questions or need help, and we'll be happy to share resources or do whatever we can, because that's the most important thing. I know it's tough, but I think that's a bit. Let's see. Jamie says, I made it so straightforward we can't think of anything to ask. I think it's probably because it's just kind of a dry subject, but it's not as exciting as sales, but whatever. Yeah. If you guys would be interested in, a second set of eyes looking at your financials, I'd be happy to do that. You can reach out to us. So Sharon says, I don't know where in QuickBooks to set up percentage. Yeah, Sharon, I'm not a QuickBooks expert, and everybody has different versions. So, the toolbars kind of change a little bit, but there is a menu option. It says saved reports, I think it is, or like in the when you hit the P&L report, the dialog box, some versions have like a little checkbox on that where you can check which it says add percentage of sales. So just kind of poke around, you'll find it. I mean, they do it. It's just different versions, whether you're online or the desktop versions, kind of different ways to do that. So just check that out. So Jamie just put her contact info in there. Check out Elhome. They are very, very helpful. You know, and Sharon, another thing you could do too, if you just want to cheat, I do this a lot too, is that just export your financials, your P&L in Excel, and then you can just set up the formulas in another column and just do it that way. Sometimes that's better because then you can play around with the data a lot easier than what QuickBooks kind of spits out in a canned format. So, all right. Well, I guess that's it, folks. Thanks for joining me, and I really appreciate you guys taking some time out of your day and reach out to Jamie. She's fantastic. And I hope to go see you guys next Tuesday at noon, where we will have the Entrepreneur Edge, where you can just ask us a bunch of questions and get your specific problems kind of addressed by the group. So thank you very much, Janet. Thanks for joining us and driving the ship as always.
Thanks, everyone. Stick around to fill out our evaluation here at the end.
Yeah. Evaluations are important. So we'll see you next week. Have a good Tuesday, everybody.
Thanks.